We want to be always closing and, again, making some calls that are based on the process. I have a lot of calls to make here, right here now. It's a very timely and topical time in the market. Not a lot of upside, I don't think, anymore in the U.S. stock market. That's not what I would have said a month ago and a couple months ago during a more obvious quad 3. I'll review that. But again, no call is ever the same. We're going to make a call here that we're going to have a quad 4 scare. So you've seen it in real-time alerts. You've seen it on a few investing ideas. Again, highlights today where I'm taking things off, making sales. There's a very important window here to be managing risk, 3 to 4, maybe 5 months. Again, that are some of the most obvious risk management windows that I've seen in my career. This is probably the third time in my career that I've seen this because I've only seen 3 economic cycle tops. And I mean pure outright economic cycle tops defined by late cycle labor being at full employment. This is only the third time, again, going back in the last 20 years, with the last 2 times being in 1999, 2000, and of course 2007, 2008, and the one that we've just rolled over from a cycle high, which was late last year. So again, no call is the same. So when I make quad 4 scare call, quad 4 scare calls, not the same call as the quad 4 in Q4, quad 4 in Q4 call that we made rather in September. But I would say that late September and making the call right now in late May is very similar in terms of what you would actually do. Okay, so that's like sell tech, sell energy, sell pot stocks. I've made all these signals very clear in the last 48 hours, and I'm going to make it much more clear on why today. Again, it's not always the same call, but there's a rhythm and rhyme to it, and there's always the same process that's behind that, which I'll, of course, get into. What's very interesting about May, late May of 2019, is that it's very similar to May of 01, May of 08. Again, markets had a big move to the upside, and again, very complacent one right before the economic cycle started to slow more obviously, and then eventually the Fed started cutting rates, and people were getting more nervous on the way down. This time, we think we're going to have a profit recession too, a quick one here for the next 2 quarters, which I'll get into as well. I also think that the VIX is undergoing a new regime change in terms of volatility, which will perpetuate the moves that I'm starting to talk about, or getting ahead of those moves. Again, not a lot of upside in the S&P. I could maybe 1.5 to 2% upside from here. So, God willing, you'll have some time to make sales on green. But again, we want to be staying ahead of that, recasting, repopulating into that quad 4 portfolio, which are already long, by the way, via treasuries, utilities, REITs. I covered consumer staples today in real-time alerts because that's actually a quad 4 long. It's a quad 3 short. Lots of different pivot moves to make, and I digress on that for now. I'll get into the details. If you look at the actual themes that we started with this cartoon, obviously, where I said if we have global growth slowing, we're going to need a lot of cowbell. Now, we're running out of the cowbell. Don't forget that the cowbell excites markets in the beginning, and then market participants get concerned about why we needed the cowbell. So again, the drying up of a lot of different things start to manifest, and people don't quite like that. They don't quite like the idea that with more cowbell, markets go down. That's the next part of the movie. And when I drip this into where I started only 6 weeks ago, I guess, with our Q2 macro themes on slide 25, guys, there are a lot of changes actually right now. Okay, and I'll come back to these. Don't worry. But again, if I just doodle on this picture, it's pretty straightforward. This 3 quad 3s in a row. We might very well have 3 quad 3s in a row, but what I'm saying is that it could look like 3, which we're in Q2, then a 4-ish, then a 3, okay? There's 3 to 4 months to deal with that sucker right there, okay? That's with an S, okay? So that's point number 1. This, bingo. Let's give that a green check, guys, because that is right on the screws, right on time, Q2 and Q3. Again, you might use that as a red check or a green check. 4 check, back check. I don't care if you're long or short here. You want to be short ahead of earnings going negative year over year. Our view is that we could be down 5 to 8% on earnings. And again, that's a Q2, Q3 view, with Q1 being quote unquote better than expected, even though that earnings, the growth rate has been cut in half multiple times. And then finally right here, on this long idea stuff, what do you think I'm going to say about this? You think I need my head red buying this stuff in the 4th quadrant? No way, no way. Sell it, all right? Bought it earlier, sell it now. You okay with that? If you're not, you're going to get a little bit more comfortable on the why. Again, be happy to come back in 3 to 4 months and buy it all back at a lower price. So again, we're going back into quad 3 because the Fed is reacting to the quad 4 and cutting interest rates. We do want to get the timing of that right. Timing is something that a lot of people struggle with, but it's something we take a lot of pride in terms of having a process to measure and map again, the timing of that all. And again, you'd have to have the profit recession, credit spreads widening, in a lower stock market for the Fed to cut rates and bring you back into quad 3 more specifically. Guys, if you draw that up on slide 6, just for the model, especially for those of you that are new subscribers, and again, all of you are premium subscribers, so again, thank you for joining us. I want you to understand this, genuinely understand this, because if you don't understand it, there's not a heck of a lot of reason to be paying for it, that's for sure. Again, so if you look at quad 3 currently, this is where we're at, okay? Quad 3 currently, this is the dot that we have, which is Q2 of 19. So that's deep in the quadrant, okay? Anywhere in here is very obvious. It's the deep end, very obvious. In as much as it would be very obvious if you're up here in the top end of quad 2. Top end of quad 2, where both growth and inflation are accelerating at the same time. You're basically short bond proxies, you're short treasuries, you're long financials. You have the opposite setup than we currently have. So again, down here it's easy. Q2 of 19, the market's discounted most of that. The tough one is going back. See how this line goes back? Let me draw that again. It's going back towards what? Q3 19, the forecast is going back towards quad 4. Not deeply into quad 4, but towards quad 4. That's why I call it a quad 4 scare. The words matter, the math matters. If the math changes, what am I going to do? I will change my mind. I will write about it. I'll talk about it. And then I'll write about it and talk about it again. But for today, right now, and for the foreseeable future, I think the best high probability decision you can make is to prepare for this path to perdition, okay? That's not a good path for markets to go down, by the way, and that's an important one for you to consider. Now, if you look at the stack on how the model is actually, and again, that's my best forecast or nowcast as of today. Okay, slide 13, guys. As of today, don't forget that we earlier in the week and throughout last week, we had economic data. We get 30 data points per month, 90 per quarter. And I'll be damned if that number isn't lower than where we started 2 weeks ago. So 2 weeks ago, I wasn't making this call. You know, I'm making that call today. That's why I'm here today. This isn't like some TV show. No, this is real time, built by a practitioner and his teammates. This is how you manage risk. You change as the data changes. This number right here, 2.56 year over year, is the lowest number that we've had so far in 2019. If you impute that into what Wall Street reads as the headline GDP number, next slide, our nowcast as of this morning. Every day we get new data, and again, God willing, 2 hands on the keyboard and 2 feet on the floor. This is a big drop, all right? So we have effectively going to 1.56%, okay? We're not only below Wall Street consensus now, but it'll be the first one handle on GDP. Now again, important point, that number will be reported when? It's a Q2 number, it's a quad 3 in Q2 number, and it will be reported when? In July. So set me up. I'm going to set you up with what the world's most likely to look like, but you need another data point. Inflation, okay, inflation. So you go to the next chart, guys, and you can see here that our inflation nowcast is actually going up this quarter, of course, not surprisingly, because we've had such a magnificent move in energy and oil related, certainly on that side of the commodity. So we go from here to here, all right? So inflation's going up and real growth is going down. That's called quad 3. But as you go this way, there's nothing but net between these two. If this number over here, 1.83, is 1.82, we're in quad 4. Okay? You get it? That just means you're moving back towards quad 4 on that slide 6 that I just showed you. If it goes to 178, 175 and piking, now the Fed's got to come in. Okay? And this is going to take some time. I think it's going to be a brief amount of time. But again, risk happens slowly, then it happens all at once. When you combine those two things, that's a much more difficult position than coming in to where inflation's back up again and you have quad 3 in the third quarter, or rather in the fourth quarter and in the first quarter. So again, this is why I'm preparing for, and again, this isn't a circus act. If you sold in May of 01, May of 08, and May of this year, by the way, don't forget the S&P's down over 3% already in May of 2019, you made good risk management decisions. So again, I want to prepare you for that. There's no subtlety to it at all. I think that that's going to be a much more difficult path for the things that I liked. And again, we like all these companies that we like in energy. It's not about the companies. It's not about the stock picking. It's not about our pot stocks. We have one of the best, if not the best, and only independent research team in cannabis. They still like the companies. I just don't like the exposure. Okay? So if you don't like that and you just want to hold, just know knowingly, consciously, you're holding energy, pot, tech, and you could have a big drawdown. Okay? I don't do that with my own money. If I know that there's a rising probability, again, this is not 100%, nothing is. If you want that, we have a guy, you guys got the orange guy? Anyway, maybe we'll show you the orange guy, but I digress. We're knowingly reducing our risk so that we don't have to take on drawdown risk. There's only one person who's batted 100% in the history of the stock market running money, and that's him, and that's certainly not me. So again, when we think about this, it's all about making good decisions within the bounds of probability that really have to do with incoming data and our market signal. Now, our market signal is a real big problem here. Again, it's corroborating and telling me to hurry up here. Don't mess around with that path back towards quad 4, however narrow that path may be. Okay, so that's an important one to think about above anything else.